Hey guys, Whitney here. Welcome. I'm just going to give it a couple minutes for everybody to file in the room. I realize I started the webinar just a tad bit early. So while we're waiting, jump on over to the Q&A box and drop in where you're joining from and what your top burning question is for today. We are talking about depreciation. And so I would love to know, because I want to be able to tailor parts of this webinar to you. So again, jump on over to that Q&A box while we're waiting, drop in where you're joining from and what your top burning question is right now regarding depreciation. All right. And if this is your first time joining, welcome to the Passive Investing Made Simple show. My name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. And we do this show on a weekly basis to help you learn the ins and outs of passive investing and to help you put knowledge into action so you can confidently go into your first or next deal. So today, we are going to be learning about the benefits of passive depreciation. And we're going to start off with one of the biggest myths that investors have that keep them sidelined. We're going to learn about the different, some different terms today, and we're going to help you put this knowledge into action. And if you don't know me, my name is Whitney Elkins-Hutten. This is the whole reason why I invest passively. This is me and my crazy crew, my husband and my daughter. But I started off real estate investing in 2002. And did quite well building up buckets of equity, doing what we call a live-in flipping house hacking strategy. Eventually moved into scaling a single family portfolio of several, a couple scores of single family homes, both within the market I live in and outside that market. And then hit a ceiling of achievement when my husband and I had a daughter, and we wanted to be able to spend more time with our family and with our daughter. And then we realized we needed to learn how to scale a much different way through active and passive multifamily investing. Now, since then, our portfolio has expanded into other asset classes like self-storage, car washes, hotels, residential, assisted living, you name it. We have actually I counted them up, for year-end goal setting planning with my husband. We have over 6,500 units now and 2,000 self-storage. I need to update the slide, but really what all of this gives us is this portfolio that we've scaled has given us 100% control and choice of how we spend our time. And I love spending my time here with you guys, helping you demystify the ins and outs of passive investing so you can go into passive investing with confidence. And we can actually help you do that here at PassiveInvesting.com. Just some quick stats here. If you haven't already jumped on the phone with one of the members of our team, we have $1.3 billion in assets under management, 3,300 multifamily units, 6,600 self-storage, 153 hotel keys, and 16 car washes, soon to quickly be expanding on that front. And we've been able to deliver over a 26% LP IRR to our investors. All right, now that you kind of know who we are, let's dive into today's topic. Okay, now since we're going to be talking about depreciation, I am going to show you some math. I want to make sure that you understand that what I'm sharing today is not financial advice, not tax advice, not legal advice. And make sure you take anything I say back to your core investment team to understand how it will apply to your specific scenario. Now, depreciation. Okay, depreciation, I'm going to say flat out, is one of the largest and most accessible tax shelters that there are out there. Now, I know that sounds like a very bold statement, but I'm actually going to show you the math behind this. And it's accessible to anyone, not just big business, okay? But in real estate, quite honestly, generates one of the largest amounts of depreciation that anybody can access without having to scale your own company. Now, what is depreciation? I took this definition from Investopedia, and depreciation is simply an accounting method used to allocate the cost of a tangible or physical asset over its useful life. Okay, what does that mean? Well, especially in real estate, we buy let's say a multifamily building. Now, the IRS knows that that building is going to break down over time, and that you as the investor are going to have to keep it in repair and quite honestly replace the building over time. Now the IRS, they understand what parts of these components break down over time, like your carpets, flooring, light fixtures. Those are going to need to be replaced more often than, say, the foundation and the roof of the building. And so they have the schedule. Okay, so they break down the building parts and give them a useful life, so to speak. Now there's 3 ways that we can access depreciation, 2 of which are accounting methods, 1 of which is a tax incentive. Now, the first way we can actually access this depreciation schedule that the IRS has set out for us, and again, this means we're partners, okay? The IRS expects an investor to take depreciation, okay? They actually penalize you if you don't take it because they know that the building is going to break down over time. You have to take depreciation. All right, now the first way is what we call straight line depreciation. And essentially you take, if you buy a building, I'm gonna show you an example here in a minute. You're gonna take it over a useful life calendar. Okay, so for multifamily residential buildings, that's 27.5 years. For commercial buildings, that's 39 years. So those schedules do change. Now, the second type of accounting method that we can use to access depreciation, to be able to take this right off, is what we call accelerated depreciation. Now, we actually are not changing at all how much depreciation we're taking, okay? It's not that accelerated depreciation gives an investor or an operator more depreciation. What you're doing is you're accelerating the depreciation, say that you would have taken in all those components across 20 years that break down in 20 years, you're accelerating to the first 5 years of the hold of the asset. Okay, so you're pushing forward those losses. And by doing that, that helps you access tax write-offs to keep income tax-free and other things, in your portfolio tax-free. Now, we do this through what we call a cost segregation analysis, meaning in order to access this type of accounting method for depreciation, the operator, or if you have your own building, you're going to go hire an engineer at a cost segregation firm, and they're going to perform an analysis and identify all those different components on that property that can be depreciated under 20 years. Okay, essentially what you're doing, you're speeding up the recognition to the earlier years of the hold. Okay, this is one of the largest business subsidies that the tax code offers businesses. Now, okay, so I've talked about what depreciation is, the 2 different ways of accounting for a depreciation. Now, I know there's been a lot of buzz on the internet about how bonus depreciation is at 100%, and this is the last year for it to be 100%, and it's going away after this. Yes and no. Now, bonus depreciation is actually not an accounting method, but it's a tax incentive. And it changed in 2017 with the Tax Cuts and Jobs Act. Before 2017, an investor could only take 50% bonus depreciation. In 2017, that changed to where an investor could take 100% bonus depreciation on qualified property. Now, what's happening is, after this year, that bonus depreciation is phasing out to pre-2017 levels. And so we're seeing that phase out over time. Now, again, this doesn't mean depreciation is going away at all. It just means, when do we get to take it and how much? So I want to make sure that we kind of clarify that a little bit. All right, so how does depreciation work? All right, let's say you buy a $1 million property. Okay, this is you personally. Okay, I'm going to explain how this works in a passive investment here in a second. But let's say you yourself go buy a $1 million property, and $200,000 of that property is actually land value. Now, you can't depreciate land. The land doesn't break down, in theory, over time. It's going to be there. But the building and the improvements, that sit on the land will break down over time. And let's assume that this building is a residential building. And so that schedule for the useful life of the asset, according to the IRS, is 27.5 years. Now, with option one, we take straight line depreciation. We're essentially going to take $800,000 and divide it by 27.5 years. Okay, that's simply what straight line depreciation means. We're going to take equal chunks of depreciation over the life of the asset. That year yields a year one tax write-off at $29,000. Not bad, right? Not bad. Now, option two, which is accelerated depreciation, we're actually going to be savvy investors. You're going to be a savvy investor. You're going to go hire an engineer that performs cost segregation analyses, and they're going to identify all those qualified components that would break down in 20 years or less. Now, let's say this cost segregation analysis says that you can now, of that $800,000 building, you could fast forward $200,000 of that depreciation to be taken through years 1 through 5 of your hold. Okay, you went now, okay, so if you take $200,000 divided by 5, that's an additional $40,000 in the first 5 years you can take, in addition to the $29,000. So you really, now you're starting to supercharge the depreciation. Now, here's the thing, you didn't change how much you get to depreciate. You just changed when you get to take the depreciation. Who wants a $29,000 year one tax write-off? Or who wants a $69,000 year one tax write-off? Okay. Now, with bonus depreciation, what we have built into the tax code right now is an incentive. And this allows an investor to take all that $200,000 they identified that they could fast forward, and instead of breaking it up over the first 5 years of the hold, they can take it all in year one. Okay. Now, that is $200,000 tax write-off, actually $229,000 tax write-off potentially in year one. Okay, sign me up, right? Now, we didn't change how much depreciation gets taken. We're only changing when we take it. Now, again, I want to draw, help you guys understand some math. In 2017 or before 2017, when the bonus depreciation was 50%, that just means you did, instead of taking $200,000 in year one, you only got to take 50% of that. That's still $100,000. That's still not shabby. That's still pretty darn good. All right. So let's move on. Like, how does this benefit you as a limited partner investor? Okay, you're like, the reason why I'm investing passively is not so I can own $1 million building by myself or even $100 million building by myself. I want somebody else to do all that work. Well, a limited partner investor can still access depreciation. And depreciation is the #1 way to legally reduce your personal taxes by sheltering income, and quite honestly, specifically passive income. And when you're able to reduce your personal taxes by sheltering passive income, you might actually allow yourself to qualify for other tax credits and other benefits. Now, for most here, personal taxes are your largest personal expense. And think about this. If you don't take advantage of this particular legal tax shelter, every dollar you spend in taxes is a dollar that you can't invest, a dollar that you can't put to work. And so again, what depreciation really does is it allows you to accelerate the time value of money. Now, there are some considerations here. We're going to talk about them because remember, what the IRS giveth, they also can take away. But again, then they give it again and telling us a couple different ways that we can keep this benefit in perpetuity. Now, how this works for a limited partner investor. Let's say you invest $100,000 into an asset that is scheduled to throw off 50% depreciation benefit in year one. Okay. And let's say your tax rate, you're going to be paying 37% tax. Okay. Maybe your effective tax rate is actually higher, but you're paying 37% in taxes total between federal and state. How does this help you? Well, the $100,000 times 50% means that in year one, you would receive, flowing through the entity onto your K1, a $50,000 tax write-off to use. Now, what does this equate actually into dollars saved? Well, simply what you have to do is take the $50,000 and multiply it by the tax rate that you're paying, okay, the actual rate you're paying, not your tax bracket, but the rate you're paying. And if your tax rate is 37%, that equates to an $18,500 tax write-off, and actually at 18.5% savings for every $100,000 you invested in year one, okay, just from taxes, just from depreciation. Now, here's where it gets really cool for limited partner investors. That asset may not have generated $18,000 in year one, okay? The income's probably much lower. Now, it's not, you can use that tax write-off to offset the passive income that an asset is generating. And you can also use it against other passive income and possibly passive gains that your portfolio is generating. So that can be an incredibly powerful strategy to help tax shelter income that's flowing into your portfolio, not just in one asset, but across multiple assets. Now, I want to kind of bust a couple myths here because I've heard it. I've spent, hours, thousands of hours on the phones with investors. And one of the myths that I hear is, if I don't pay taxes, that's bad. I have to pay my fair share of taxes. Here's the thing. This is a legal maneuver in order to shelter income through taxation, or shelter your income and avoid taxation. But also, as an investor, you are still paying taxes. It's just that those taxes have been shifted to the actual business level, okay, where that property is, where that holding is. That business is still paying local real estate taxes. It's still paying, employee taxes in that area. You're just shifting how and where you pay that tax, okay? Now, here is a fact that I want to point out, is that not all operators share or allocate the depreciation that an asset could possibly generate pro rata. So that is something to watch out for as a limited partner investor. Make sure you're getting a pro rata share of your depreciation. All right, now I said there was going to be some considerations here, because what the IRS giveth, they might take away, or they can take away. Now I'm going to define these couple of things, and then I'm going to show you how to sidestep depreciation recapture. Now, again, depreciation is a partnership with the IRS. So when you sell the asset, you're breaking up your partnership with the IRS. Okay, as long as you hold the asset, you get to continue to take the depreciation on the asset. As soon as you sell it, the IRS is like, whoa, we're no longer partners. What's happening here? Well, they're going to be able to charge two things to you. One, depreciation recapture tax. And essentially, this is a tax on the amount of depreciation actually taken. So say you could depreciate, again, our $1 million building, you can depreciate up to $800,000. But you sell the building and you've only taken, $200,000 of depreciation. Okay, you're not getting taxed on the full $800,000. It would only be on the $200,000. Okay, so not as scary. And then you've got capital gains. Okay, so again, when the asset's sold, the partnership is terminated, equity and gains are distributed, and the profit portion is a long-term capital gain. So essentially, you're paying tax on the gains. Now, how do you get back in partnership with the IRS? There's a couple different ways. So let's talk about what all of your options are. The first option is the poor man strategy. You pay the recapture, you pay the capital gains, and then you go with your remaining capital, you go buy a boat and you sail off into the sunset, okay? This is not helping you shelter any more income or gains, utilizing depreciation from the tax code. Or you can reinvest, okay, through a 1031 exchange. Okay, this is what I call and a lot of people call the buy, borrow, and die strategy. So you can continue if you trade up assets, okay, and don't take possession of that gain on the sale of the asset, and you continue to trade up assets, kind of like play Monopoly. You take your four houses and go buy a hotel. Now you're continuing to defer the capital gains taxation as well as the recapture on depreciation to future years. All right. And here's the thing. Right now, if you die with those assets in place, they go to your heirs and that all gets washed away. Right. This is what the 1% is doing to build their wealth. Now, there is a third option here. And guys, I covered this pretty extensively in a masterclass back last May. And I'm sure I'm going to do it again here this next year because, it just kind of blew people's minds. But there is a way to do an offset strategy where you can use, again, passive losses from other passive investments to offset your recapture and gains on the asset that you just sold or exited out of. And we call this the lazy man 1031 exchange. All right. Because remember, all these passive losses, tax write-offs that you're generating from your passive assets, even if you can't use them in the first tax year, they're going to suspend and you can use them in future years. And you can build up what we call that golden bucket and offset as assets enter and exit out of your portfolio. And it's these last two strategies, those are how the wealthy are building their wealth. Now, I want to talk about, again, what assets have depreciation and kind of how to understand how much might be there. And it depends on a couple of things. It might weigh in on something on how the asset is purchased. But really, the two largest things is it depends on the asset class, okay? Multifamily residential real estate, that time schedule, that depreciation schedule, it is 27.5 years. For self-storage, it is 39 years. And for car washes, it's actually a little bit different. Here we have book depreciation or business depreciation. It also depends on the business plan that the asset, especially moving forward. Is it a core asset? Okay, is there any improvements being done on the asset? Is it a value add strategy? Or is it a development? Okay, that's also going to impact how much you can take in the early years of the asset. Now, if it's a flip, like I know I used to do this. Still do it every once in a while. I'll buy a single family property, I'll fix it up and I'll sell it in a very short time period, say in 12 months or less. That's a flip. There's actually no depreciation to take because it was never a buy and hold strategy to begin with. All right. All of these things, to be able to access the best depreciation on an asset, you want to either you yourself perform a cost segregation analysis, or if you're investing in a limited partner investment, a passive investment, ensure that the operator is performing a cost segregation analysis. All right, so how do I access these benefits before the end of the year, right? We're doing this webinar on November 8th. 2022, and I know I've talked to so many investors that are like, oh my gosh, I need tax benefits before the end of the year. Okay, first of all, my comment is don't let the tax tail wag the dog. Make sure you understand your investing goals and what assets actually truly are going to belong in your portfolio. Don't take unnecessary risk in your portfolio just to access tax benefits. Okay. Now that I've got that out of the way, for us, we are looking to access multifamily core plus assets that have a year one depreciation somewhere between 40 to 60%. And our intent is to hold this asset and do 1031 exchanges. Also in our self-storage, we're looking at core plus and value add strategies. And our year one depreciation, we're looking somewhere between 30 to 50%. And again, same thing, we're looking to hold, build that portfolio, grow that portfolio, and then 1031 exchange out. And our car washes, again, this is the depreciation is different. The schedule is actually going to be business depreciation, not residential or commercial real estate depreciation. We're accessing core plus and value add assets, as well as we're doing our own developing. Okay, remember, double asterisk there. You can't do depreciation on the development piece, but you can when you hold it. We can access year one depreciation of 70 to 90%. Okay, and again, we're on that exit strategy. We're looking to hold and IPO that portfolio. So this is your invitation and your call to action. If you are in need of tax benefits before the end of the year, make sure to reach out to me at passiveinvestingwithwhitney.com. And there, not only do I have some free education goodies for you, I can show you what deals that we have open and what could fit very well into your portfolio and help you out, really help you meet your goals. And again, here's my contact information. Feel free to reach out to me. I'm going to hang on. For those of you who have joined live today, we are going to have an open Q&A session. If you have joined on your favorite podcast of choice, be sure to check out passivewithwhitney.com, or you can reach out to me at whitney@passiveinvesting.com.